Hello, I'm Dr. Laura Penn, and welcome to Green Views, a talk show about green issues and green solutions, in partnership with Dukascopy TV. Why should the financial sector care about the environment? Or about environmental risk, for that matter? Here to answer this question, and to give us insights into how the financial sector can measure environmental risk, is Ivo Mulder. He is the economic advisor for REDD+, and he works for the United Nations Environment Program, or UNEP. Ivo Mulder, welcome to Green Views.
Thank you, Laura.
I'd like to start by asking you, why is it important for the financial sector to be a part of, to be an ally in environmental challenges?
Well, the financial industry plays a very important role because to a certain extent they determine how capital is being allocated and where capital is being allocated. A growing number of leading companies such as Coca-Cola or Unilever have determined for themselves that it's in their financial interest to reduce environmental impacts. But an even bigger number of publicly listed companies or stock exchanges or privately owned companies do comparatively little. To give you an example, 45,000 companies listed on stock exchanges around the world. Of these, around 10% are generally being tracked on their environmental performance or the social performance, and less than 1% can be considered best in class.
That's very few.
Yes. What to do about the 90% that are not being tracked on their environmental performance or their social performance? And I think this is where the financial industry can play a very important role. By factoring or including environmental issues such as greenhouse gas emissions or water scarcity or deforestation in the projections of future costs or revenues of their clients or investee companies, the financial industry can play a very, very important role.
Which leads me to ask you, what are some examples of some leading initiatives that are charging the way?
Sure. I think a very interesting example is Carbon Tracker. This is an initiative that has started to price carbon risk for fossil fuel companies. So governments around the world have started or have agreed to avoid dangerous levels of climate change by limiting greenhouse gas emissions in order to ensure that we stick within the 2-degree temperature rise. And as you can imagine, fossil fuel companies are very carbon intensive. So this initiative, Carbon Tracker, have assessed what is the effect if greenhouse gas emissions cannot be emitted freely anymore on their financial performance. And they have found that 60 to 80% of their existing coal reserves, oil reserves, gas reserves cannot or will not be able to be utilized anymore in a carbon constrained world. And I think a good example is Obama's Green Power Plan.
Why?
This plan foresees in a reduction of 32% of greenhouse gas emissions by 2030 compared to 2005. And this will undoubtedly have an effect on investments in coal, but also other carbon-intensive energy generation. A second initiative that I would like to mention is the Natural Capital Declaration. The Natural Capital Declaration has been signed by more than 40 CEOs of banks, investment funds, and other types of financial institutions. And the idea is to mainstream deforestation risk, water scarcity, and other types of environmental issues in the performance of loans, bonds, and stocks.
Okay, well, these sound like two very robust initiatives. Is there a need for more?
I think what is important is that these are being picked up by mainstream players. And I think a very good example is a release of a new product this week by Bloomberg and by the Natural Capital Declaration in London that allows financial analysts, portfolio managers to directly integrate water scarcity in the future projections of cost and revenues of mining stocks. And I think unlike carbon emissions, which will only become financially material if governments decide to cap it, water is actually a very important input in the production process of a lot of companies, including mining. And ecosystem degradation, population pressure, and high levels of water use by the agricultural industry means that water is increasingly becoming a scarce issue. And this model allows the financial industry to see how water scarcity will have an effect of mining stocks that they have in their portfolio. And just to give you an example, the mining industry has seen investments in water infrastructure, such as desalination plants and water treatment plants, increase to $12 billion last year. Which is 2.5 times more than they were spending only 6 years ago. So I think this is highlighting that water scarcity as an emerging ecosystem issue is quickly rising as being very financially important.
And just tell me, what's the name of this new initiative?
It's the water risk valuation tool.
Okay, we'll be looking out for that one. And then what's in your crystal ball? In the near future, 3 to 5 years from now, what does the landscape look like?
Well, I think that we're only at the starting point of a period where environmental issues will become commonplace, where companies will have to do something about it. Consumers are increasingly demanding good corporate behavior from companies where they buy their products from. And governments have the ability to regulate the use and impact on natural capital, on ecosystems. And even though investor interest has been relatively limited to date, because a lot of mainstream players did not see a robust business case, I think these types of government examples, but also quantitative financial tools, allows financial institutions to see how environmental risk will have an effect on their own portfolios. And I think this will definitely see some mainstream interest in the years to come.
I'll be keeping my eye out for what happens. Ivo, thank you for these valuable insights. And thank you for watching. This is Dr. Laura Penn with Green Views, a talk show about green issues and green solutions, in partnership with Dukascopy TV. Until next time.